sent you an email regarding the competition and the judges and everything like that. The guys from the venture capital, they are like wondering if it's still fine, still everything correct.
Yeah. Thursday, right?
It's Friday, no?
Thursday. It's a week from Thursday, I thought.
Yeah.
Or is it this Thursday? I think.
Thursday. It's second.
Okay.
It's second, yeah.
I'm pretty sure it's Thursday.
Yep. On November 3rd.
Yep, that's this Thursday. That's this Thursday.
Yeah, okay, yeah, November 3rd.
Okay.
Yeah,
All right, thank you very much.
Okay, folks, let's get started. Couple of reminders. The first is that your DCF is due this Friday, right? You know what happens when I get the DCF, right? I'm not going to grade it, I'm just going to take a look at it, and I'll try to get it back to you almost instantaneously. Depends on whether you send it at 5 o'clock on Friday, in which case it'll just pile up because there'll be 100 coming in. But if you send it earlier, I'll try to get it back. There are 2 of you who've sent it in already. I'll try to get those back today, but the rest I'll get back. So all I'm checking for is internal consistency. So I'm not going to contest you on revenue growth rates because that's your story, it's your valuation. Okay? So I know you feel this urge to test your assumptions out on me and say, am I making the right assumption? My answer is always going to be the same, and I'll preempt it. I have no idea. It's your company. You know more about your company than I do, or you should, because I haven't been looking at your company. And it's your story to tell, your company valuation. And I'll tell you, the toughest part of valuation is letting go of past numbers. I know many of the emails I've been getting are last year's number was, and you're acting like you're stuck with last year's numbers. Last year's number is an input into the process, but you don't have to use it. So last year's reinvestment rate can be 350% or minus 55%, but it's still your choice. So use your choices. It's your company, it's your story, it's your valuation. Tell me your story about your company in the form of numbers. That's what this valuation is about. That's why I have no qualms about you using my Excel spreadsheet. This is not a modeling class where you build spreadsheets. That's a skill you can work on. This is not the class where I want you to work on that skill because, as I said, becoming an Excel ninja is not something I want to work on in this class. There are so many more critical things I want you to focus on. So feel free to use my spreadsheet. It's basically all it is a framework. Your numbers still drive your valuation. I'm not valuing your company. So the one thing is, don't blame me when your valuation breaks apart. It's something in your story that's really not working. Not the spreadsheet doesn't value your company. So let's start today's session building on some concepts that you are probably running into in the context of your DCF. I don't know whether any of you are familiar with the Tata Group. The Tata Group is one of India's longest standing. It's been around since 1868. In fact, to show you how much continuity there is in that group, in the 150 years they've been around, they've had only 7 chairmen. So that kind of gives you the sense of the tenure. Among Indian family groups, it is considered one of the best run and most credible groups. But last weekend, a new story came out that they're trying to push out their existing CEO. The whole thing is blowing up. But this is part of an issue that you run into with family group companies. And we're going to talk about valuing family group companies. In fact, I will value 4 Tata companies. And we looked at this in the context of corporate finance. We remember we looked at Tata Motors as one of the companies that we analyzed. And I talked about how the group's interests can overwhelm the company's interests. There's also this issue of corporate governance, which is you have almost no say in how these companies are run because the family basically makes the big decisions. So let's put this into practice. Let's suppose you're valuing a company where you're concerned about corporate governance. And it's not just family group companies, right? This is an issue when you're valuing Tesla. When you're valuing any company with a strong-willed CEO who has the power to make big decisions that you cannot contest, let's say you come up with a DCF value of $100 million for the company, but you think there's horrible corporate governance in this company. Basically, that means you have no chance of changing. Should I attach a discount to my DCF valuation? Anybody want to give it a shot? I mean, because this is an issue that some of you are dealing with. You come up with a value. What do you think?
Probably bring that into the expenses instead of a separate discount.
Okay. The first issue is, who did the DCF? You did, right? Along the way, you made some assumptions about the company. So let's say that one of the things the company is doing is it's investing and earning a return on capital of 5% on its project, and its cost of capital is 10%. Now, if this company had strong corporate governance, you'd assume that this can't continue for very long. Somebody's going to stop the management, change the company, and therefore the return on capital has to climb at least to the cost of capital. Pretty intuitive, pretty straightforward. But if your company has bad corporate governance, here's what you might have done in your DCF, and that's why it depends. If you've left the return on capital at 5% in perpetuity, what are you telling me? That even if the company is badly managed and badly run, you are not going to be able to change the company. Your DCF value already reflects the bad corporate governance. Attaching a discount to that value would be double counting. But you can see why the answer, it depends, right? Because if in your DCF you assume that the return on capital would improve to the cost of capital, you acted like this was a well-governed company, then you might have to go back and say, did I do the right thing? So whether you attach a discount or not very much depends on what you've assumed along the way in the context of your DCF. So it'll show up in your investment policy. Will it show up in your financing policy? Let's say your company has no debt, that it can afford to have a 30% debt ratio based on its cash flows. Again, we call this a target debt ratio, an optimal debt ratio. If you have a company with good corporate governance, moving your debt ratio towards the optimal is the sensible thing to do, because there will be pressure on the company to go out and borrow more money. Look at Apple. One of the largest companies still face pressure to go out and borrow money. But if you have a company with bad corporate governance, you might leave the debt ratio at 0%, saying this family that runs this company hates to borrow money. There's nothing I can do about it, and I'm going to leave the debt ratio at 0%. You control the levers, and what you've done with those levers will tell you whether you should be attaching a discount or not. Any questions on corporate governance? We talked about capitalizing R&D, right? We used the example of Cisco and how capitalizing R&D. And this was part of your first quiz, is what that does to your operating income and what it does to your cash flows. Do you remember the last question on your first quiz? What is the question? What did the question ask? No? Nobody remembers? It was about the R&D effect on free cash flow to the firm, right? When you or it was actually cut it was like R&D, but it was really a human capital firm, the recruiting and training expenses. So I said, when you capitalize R&D, or R&D-like expenses, what effect will it have on your free cash flow to the firm? And I gave you three choices. The free cash flow will go up, the free cash flow will go down. I actually gave you four choices. The free cash flow will remain unchanged, or it depends. And what is the right answer there? Do you remember? It does not change, because you're still spending the money. No matter what you do, you're still getting the same tax benefits no matter what you do. The free cash flow is not affected. And if you left it there, you're saying, why the hell are we then capitalizing R&D if it doesn't affect your free cash flow? So I'm going to ask you the follow-up question. When you capitalize R&D at a company, let's say you run a DCF valuation of a pharmaceutical company, you come up with a value per share of $20 without capitalizing R&D. You decide to capitalize R&D. Your operating income is going to be different, your net capex is going to be different, but your free cash flow to the firm from last year is going to be unchanged, right? So my question is about value now. Will the value per share for this company remain unchanged? Will it go up? Will it go down? Or is the answer it depends? It looks very much like the last question, right? The free cash flow doesn't change. You're saying, why the heck would the value change? That's really the question I'm asking. The free cash flow didn't change when I capitalized R&D, but what else changed? My return on invested capital changed, right? Because I capitalized the R&D. My reinvestment rate changed. Now do you see the opening I've given you? If the return on capital and the reinvestment rate change, your growth rate changes. If your growth rate changes, even if your free cash flow to the firm remains unchanged, your value as a company could change. Will it go up or down? What am I doing when I capitalize R&D? I'm treating it like any other growth investment, right? And does investing in growth increase your value or decrease your value? What does it depend on? The return on capital I make on that investment being greater than the cost of capital. If your R&D is good R&D, which means you're creating value, capitalizing R&D will increase your value. If it's R&D that's wasteful R&D, in other words, you're spending money and nothing is happening to your earnings, your value per share will actually go down when you capitalize R&D. And that's exactly why we capitalize R&D, is to get a better sense of whether you're doing good R&D, bad R&D, or just neutral R&D. Last example. Some of you are valuing companies where there is the potential for distress. How do you know your ratings? Your bond rating is CCC, single B. There's talk about the company not being able to make it. You ignore all that talk. You do what you always do in a spreadsheet, is fix all the problems, right? So easy to do. Take low margins, make them high margins. Take a high debt ratio, make it a low debt ratio. And on your spreadsheet, you create this nice, healthy firm 10 years out. You get this big terminal value, you discount it all back. You come up with the value of $1 billion for the equity in the firm. But remember, it is still a distressed firm. You fixed it, but only in your spreadsheet. Are you overestimating value, underestimating value, or is there really no effect on value of this distress story? Have I incorporated distress already into my DCF? That's really the question, right? Because if you can argue that it's already in the discount rate, then you say, okay, no reason to adjust. But is it? What risk is in your discount rate? The risk that your earnings and cash flows will be different from expected in big ways, right? What's the risk you're worried about? It's not that your year 3 cash flows are going to be wrong. It is that there will be no year 3. I've talked off and on about truncation risk in this class, about nationalization risk, distress risk. Discount rates are terrible instruments for conveying that risk. They were never meant for that kind of risk. They're meant to carry going concern risk, and a DCF valuation is a going concern valuation. And if you're under serious threat of that assumption breaking down, you will overvalue companies. So if you value a distressed company using a DCF model, even if you do everything by the book and you do it right, you will overvalue the company because you're ignoring what happens if your company doesn't make it. So today, towards the end of the class, we're going to talk about what to do about these companies, because clearly you can't just wave your hands and say, hey, there's distress, I know I've overvalued the company. You have to tell me exactly how you're going to adjust the value of the company. So let's go back to the slides, because I think we were on, this is perfect for Halloween Day. Okay? So I'm going to start talking about what I call the dark side of valuation. I'll tell you, this is my favorite place to be in valuation. Okay? Let me explain what I mean by this. If I gave you a money-making company with an established business model, with a nice protected market, valuing it is simple, right? In fact, you don't need to take this class. You could just pump in the number, put in a growth rate. You can value a company like that with no effort at all. The real challenge in valuation becomes how to value companies where the questions, remember the 4 questions I said you need to answer for any company? When answering those questions becomes difficult. So let me set up the framework. When you sit down and look at a company and you want to value the company, here are the 4 questions you need answers to. What are your cash flows from existing assets? And for that, you're going to go look at the current financials, the annual report, the 10K, the 10Q. What is the value added by growth assets? To answer that question, you look at what kind of return on capital they're making on their projects, what their cost of capital is. How risky are those cash flows? And for that, you go back and look at betas and cost of debt and bond ratings and debt ratios. And when will your firm become a mature firm? And here you look at the rest of the sector to see what a mature firm looks like. Those are the 4 basic questions, and if those questions can be answered easily, then valuation becomes really simple. Now, do you see why stable money-making companies with a long history are easy to value? When I ask you what are the cash flows of existing assets, you show me your financial statements, and your financial statements pretty much tell me what the cash flows are. When I ask you what the value of growth is, you compute the return on capital you've earned for the last 20 years, and because the business is mature, you say, hey, I've earned 10% as my return on capital. I don't see anything changing, so let's keep using the 10%. Now I ask you what your cost of capital is. You can pull up regression betas, sector average betas, a debt ratio that's stable. All the numbers become pretty much set, and your valuation kind of follows. This is where traditional financial modeling works fine, right? Because all you need to do is take past numbers and project them out, and your valuation is going to work. So let's think about when valuation becomes difficult. First, valuing young companies, that's what I'm going to start off with today, is going to be incredibly difficult to do, especially if these companies are startups or very close to being early in their life cycle. Why? Because you don't have financials, you don't have history, it's going to be much more difficult. Companies that don't fit the accounting mold. The accounting mold is designed for manufacturing companies, right? So if you bought land, you built a factory, you produce goods and services, accounting works fine. If I give you a pharmaceutical company, a consulting firm company, even if it's a mature company, you're going to have more trouble, because coming up with things like return on invested capital is going to be more difficult because the invested capital doesn't reflect your true investments. And companies that face substantial truncation risk. I talked about distressed companies. I could say the same thing about companies that could be nationalized. Companies where the regulations can change dramatically overnight. Those companies, again, valuation is going to be difficult. And when valuation becomes difficult, people start to do strange things. So I'm going to talk about a range of difficult to value companies, and somewhere along the way, hopefully your company, maybe you have an easy money making company, in which case this class was kind of unnecessary. But if you have one of these companies, maybe along the way I can hit your company. So I'm going to start off with companies across the life cycle. I'm going to start off with young startups and talk about how to value them and what the challenges are in valuing them. Then I'm going to move on to mature companies, which are usually easy to value. But then I'm going to talk about mature companies in transition. What does that mean? Mature companies do the same thing over and over again. Their defining force in how they do things is inertia. And that works fine if the world hasn't shifted. But if you're a mature company and the world has shifted under you, at some point in time, doing what you've always done doesn't work, and you have to talk about changing. Valuation becomes difficult again because the past history is no longer going to work. This is happening with food companies in the US big time. Because for a long time, food companies in the US, the Hershey's, the Hormel, could do what they'd always done and get away with it. Now that's no longer working. And then I'm going to talk about the most depressing valuations of all, which are valuing declining companies where the end in sight is not a good end. So if you're valuing a retailing company, you're pretty much here, right? What retailing company is it possible to give a nice optimistic story on anymore? So we'll talk about valuing those companies. So across the life cycle. I also want to talk about across markets. What's so difficult about valuing an emerging market company? Okay? I don't think we need to rewrite the valuation rule book, but we'll talk about the special challenges in terms of governance and cross holdings and country risk. And finally, I want to talk about companies and sectors. I want to start off with banks and financial service companies. Again, a topic I've kind of hit and run along the way. Commodity and cyclical companies, oil companies, gold mining companies. And finally, firms with intangible assets, as the accountants like to call them. Pharmaceutical companies, human capital companies. So lots of different businesses to look at. Let's start with young companies. You ready? You be an entrepreneur with a startup. I'm going to come to you with those 4 questions. Remember the 4 questions I need answers to? And you can already see why valuation is going to become a nightmare. You ready? You start in your company. It's a company with lots of promise and potential. What are the cash flows from your existing assets? You're saying, what existing assets? I don't even own the chair I sit in. So that was easy. Let's put a 0 there. What's the value from future growth? It's a lot. Can you be a little more specific? Not really. You don't have a product. You don't have a market. You can't point to history. How risky are you? Very. You know, what beta? Cost of debt. There's no bond rating, no debt ratio. When will you be a mature company? You fall out of the chair laughing. You don't even know whether you'll make it through tonight. Every question becomes difficult to answer. And guess what? When every question becomes difficult to answer, the dark side beckons. What's the dark side? Well, if you think about valuing a company like this one, let me magnify your problem. let's assume that when you sit down to value a company, let's think about all the places we go to get information. We start off with the current financials of the company, right? That's always the starting point. Last annual report, last 10K. And with a young startup, there's not much there. You look at the past of the company, but it's not been around, so there's no history, no financials. You look at other companies in your sector hoping to get clues about what margins are. Let's assume that every company in your sector looks just like your company. They're all young startups. This is the trifecta, right? You have no history, no financials, no comparables. And here's what the dark side will look like. You start creating metrics that nobody's seen before. Like what? Value per website visitor, value per user, value per subscriber, value per whatever. Basically, you're saying, I can't come up with a value for these companies, so let me divide the value by something. You start telling me macro stories. Whenever I ask you about the company, you talk about global shifts in social media, or China, or cloud computing. You name it, basically you go to the macro story. And you talk about paradigm shifts, which means you have no idea what's going on, but you'll call it a paradigm shift. This is the dark side of valuation, and I first ran into it frontally in the 1990s. So when I would do my valuation sessions, and this was as the dot-com boom was rising, at the end of the session somebody would come up to me and say, you really cannot value Amazon.com using a DCF model, can you? And they have this finger going like this, please step back, you're going to hurt me. At the risk of grave personal injury, I'd say, no, you can value Amazon using a discounted cash flow model. And they'd give me this look of total contempt. Say, academic. And walk away. And after about the 5th or 6th time of being called an academic, I got really pissed off. I said, you know what, I'm going to try to value Amazon using a discounted cash flow model. First time I valued Amazon was in 1998. And I kept a journal as I was doing the valuation. Journal of what every roadblock that I ran into and what I had to do to get across the roadblock. To show you how many roadblocks I ran into by the time I was finished with the valuation of Amazon. The journal was 75 pages long. It's actually still on my website. It's called The Dark Side of Valuation, Can Amazon.com Be Valued? That journal was actually the basis for my first edition of my Dark Side of Valuation book, because publisher looked and said, this is almost a book, why don't you just make it a book? So okay, yeah. At the very start of this class, I said everything I know about valuation I've learned in the course of either teaching this class or doing valuation. Everything I know about valuing young startup companies I learned in the process of valuing Amazon. I will forever be grateful to Amazon for just that reason, because everything I do comes from it. So I'm going to take you back to January 2000. It's a very early valuation of Amazon. You know what's already happened to Amazon, so it's impossible to keep that hindsight bias from kicking in, saying, I know what's happened. I'll confess, in 2000, I didn't see all of this happening. I didn't see cloud computing coming 10 years later, and but this was my valuation of Amazon. I'll frame the valuation by the time period at which it was done. January 2000 was the peak of the dot-com boom. The NASDAQ had just hit 5,000. Dot-com stocks were the place to be if you're an investor because they'd made so much money. Amazon was trading at about $84 per share. So I was actually approached by AIMR, which is the organization that runs the CFA, and they asked me, could you do a webcast on valuing dot-com companies, because there's no way you can come up with these values. So it's impossible, right, to value a DCF, to value these companies using a DCF. And I took up that challenge. In fact, that webcast is also on their website. Don't go pay for it because they will charge you, so I'll give you the shortened version of that webcast right now. So I'm going to take you through my DCF valuation of Amazon. And along the way, I'm going to talk about the barriers I ran into and what I had to do to get over them. So let me start with the numbers. In January 2000, looking at the 12 months leading into the valuation, Amazon had revenues of $1.1 billion. $1.1 billion for a US retail company is almost no revenues. It's a tiny company with an operating loss of $410 million. So let me pause right there. You have a company with big losses on small revenues. Can a company with small revenues and big losses become a valuable company? It's an easy question. Of course, right? Every company at some point in time had small. So let's make this really simplistic. For this company to become valuable, what has to happen to those small revenues? They have to become big revenues, right? And what has to happen to the losses? They have to become profits. I know it sounds incredibly simplistic, but the two big assumptions I'm going to start this game off with are revenue growth. Why do I need it? To make small revenues into big revenues. And a target operating margin. Why? Because I know they're not making money now. I know they won't make money in the near future, but eventually I have to see some light at the end of the tunnel. So the first two big assumptions I made in the Amazon valuation were revenue growth and margins. I'm going to come back and give you the specifics of how exactly I came up with these numbers, but the revenue growth I estimated for Amazon was 42% as a compounded annual growth rate for the next 10 years. Two key words there, compounded in 10 years, 42%. This was one of the first live webcasts that AMR was doing. And as I was doing the webcast, people were emailing questions. It's the most distracting process ever. People are thrusting the questions in front of me. I hadn't even finished saying 42%, and the first question comes in. How come you're being so pessimistic about future growth? I said, pessimistic? I have $1 billion in revenues right now. What are my projected revenues in year 10? Or year 11? But $40 billion. So I'm making $1 billion in revenues into $40 billion, and you're accusing me of being pessimistic. You know why it sounded pessimistic to them, though? What were they comparing the 42% to? Revenue growth in the most recent year, which was 200%. So how come you're dropping? They forgot the compounded in the 10 years. I was actually projecting revenue growth of 150% in year 1, but as the revenues got bigger, I had to bring the growth rate down. So I thought I was being pretty optimistic. You're saying, why 42? Why not 50? Why not 35? I'll come back and talk about why I picked 42. But I've made small revenues into big revenues. I'm half the way there, right? My second problem is I'm making these big losses. My operating margin right now is minus 36.71%. If I leave it at minus 36.71%, there's no point doing the valuation. There will be no company in 2 or 3 years. So I had to estimate what their margins will be once they became a mature company. Initially, I looked at other .com retailers, and guess what I saw? They were all losing money. At that point, I had to step back and say, what's this .com thing even doing in this process? They're a retailing company. I know what the retail business looks like. Let me go look at the brick and mortar retailers, and I actually focused on the high end, the specialty retailers, and their margin, pre-tax operating margin, was about 10%. I assumed over the next 10 years that Amazon's margins would go from minus 36.7 to plus 10. I'm being realistic. It's not going to happen next year. It's not going to happen 2 years. But over the next 10 years, as they move towards maturity, the margin's going to become plus 10%. So my losses become profits. I'm almost home, but there's one final loose end to tie up. To make my revenues go from $1 billion to $40 billion, it's a lot of growth, right? And what was the lesson we kind of re-emphasized over and over when we talked about growth? To grow fast, you have to reinvest. Initially, I tried that little game of return on capital times reinvestment rate, but I ran into a very simple problem. What's the return on capital in my base year? It's a big negative number. What's my reinvestment rate in my big base year? It's a big negative number. You're saying this is very convenient. Big negative number times big negative number is a big positive number. But it doesn't work, because if I put a positive growth rate on a loss, it's just going to get bigger. This is the roadblock I got stuck on for the longest. How do you estimate reinvestment for a young growth company? You cannot use the sustainable growth equation because the margins are changing. You cannot look at history. Why not? There's not much there. What am I going to find out about capex and depreciation and working capital? So after about 2 weeks of struggling with different numbers, I came up with a ratio that I use to this day, which is that sales to capital ratio that you saw when I did Tesla, which is the only positive number in my forecast is revenues, right? So I have to tie reinvestment to revenues because that's what the company's focused on. So the sales to capital ratio of 3 basically means for every dollar that Amazon reinvests, it gets $3 in revenues. You know where I got that number? I looked across retailers. I looked at .com retailers. Across those companies, that number was about 3. That's what I used to get the reinvestment. The way this works out is every year I take the change in revenues, I divide by 3, I get a single line item that I call reinvestment. But you know what's in there? CapEx minus depreciation plus change in working capital is all consolidated into one number, and R&D and acquisitions. You're saying, why aren't you breaking it down? Because I don't know where the reinvestment is going to come from. Amazon doesn't know where the reinvestment is going to come from. So let's recap. My small revenues grow to become big revenues. My losses become profits as my margin goes from minus 36.7 to plus 10. My reinvestment each year is tied to my revenue change. So all I do is divide by 3. I have everything I need to get my free cash flow to the firm. And this is my optimistic valuation of Amazon. Take a look at my free cash flow to the firm in year 1, minus 931 million. Pause right there. What am I assuming that Amazon's going to be able to do in year 1? If you have a negative cash flow, I've got to raise fresh capital. And I'm also telling you exactly where they're going to raise the capital, because when I use my debt ratio of 1% and 99% equity, I'm also telling you that's how they will raise fresh capital, primarily from issuing new equity. Minus 931 in year 1, minus $1 billion in year 2, in fact, my cash flows are negative for the first 6 years, and that doesn't surprise me in the least. Why? Because I am pushing this high growth, and that high growth will mean reinvesting and reinvesting and reinvesting, and that's going to keep my cash flows negative for the first 6 years. Eventually the cash flows turn. Why? Because growth starts to decline. There's good news in growth declining, because it's only when the growth starts to level off, become lower, that my cash flows turn positive. And by the time I get to year 10, I've got a company I can work with big positive cash flows that I can use to get the terminal value and the discounted cash flow valuation of the company. So 3 big assumptions: revenue growth, target margin, sales to capital. I have to discount these cash flows back at a cost to capital, right? Let me rephrase it, at costs of capital. Why? Because think of how much Amazon is changing on my spreadsheet. In year 1, when I look at Amazon, it's a small money losing company, right? By the time I get to year 5, it's got $19 billion in revenues and it's making $1.6 billion in profits. It's no longer a small money losing company. It's starting to become a bigger, more retail type company. And by the time I get to year 10, it's a $40 billion company making an operating income of about $2.5 billion after taxes. It is now a mature company. You're saying, so what? When I started the game, I gave them the cost of equity reflecting a young, risky online retail company. A beta 1.6 and a debt ratio of 1%. Why only 1%? They don't have any earnings. What's the point of borrowing money if you don't have any earnings? You don't get the tax advantage. It's just an added layer of penalty you've got to face. So initially when I did my cost of capital, high beta, high cost of equity, low debt ratio, my cost of capital is 12.84%. By the time I get to year 5, I take a look at my number and say, I can't leave this at 12.84% because I've made my company larger and more profitable. So starting in year 5, I start stepping down the cost of capital from 12.84% down to 9.6%, which in 2000 was a cost of capital for a mature company. Today it'll be too high because the risk-free rate is much lower, but the risk-free rate in 2000 was 6.5%. Okay. File that away because that's going to come back when I do my terminal value calculations. The risk-free rate was 6.5%. So over time, as the company gets safer, the cost of capital decreases. I get to year 10 and I'm tired. I don't want to do this anymore. I put the company into stable growth. Remind me again what stable growth requires me to do. Assume that the company will grow at a constant rate forever. I used to growth rate of 6% forever. Didn't I beat up Evercore for using 6% on the Tesla valuation? How come I'm using 6% and not beating myself up? I don't like beating myself up. That's part of the problem. But why was 6% okay in 2000? The risk-free rate was 6.5%. It's a very different world. Higher inflation, almost a 4% inflation rate. 6% worked then. That's why you can't have absolute rules on growth rates in perpetuity. I used a 6% growth rate forever. That, of course, gives me a huge terminal value, which I should expect because I've made this company an immensely profitable company. I discount those cash flows back at the cost of capital. I get a value for the operating assets of all the cash flows, including the terminal value, of $14.9 billion. I had cash, which is tiny. It shows you how confident they felt about being able to raise cash. They'd run it down to almost zero. The debt was $349 billion. I get a value for the equity of $14.587 billion. Then I remember that last loose end about equity options. And I said, it was a waste of time. Maybe I should skip it. Thank God I didn't skip it, because when I valued the options outstanding at Amazon in early 2000, I got $2.9 billion. The company had given away 22 to 23% of its equity to its employees and its management. And this is, I think, the downside of using equity compensation is you are giving away bigger and bigger slice of the company. Divide by the actual number of shares, the value per share that I got was $34.32. The decimals are there just to make it look like I'm being precise. Let's say it's roughly 34. What did I say the stock price was? It's $84 at that time. So I knew exactly what the last question was going to be on this webcast. You know what the last question was? What's the question you ask about faith in your valuation? When I came up with something undervalued, say, would I buy? You know exactly what the last question was. Are you selling short? And I said, not in this lifetime. And they said, aren't you confident in this valuation? I feel far more confident that Amazon is overvalued in January 2000 than I was in any of the undervalued companies I was buying at the same time. So how come I'm not willing to sell short on a company that I think is significantly overvalued when I was willing to buy those companies that I felt were significantly undervalued? What has happened for you to make money? The price has to, even if you're right, the price has to adjust to value. When you find something undervalued, how much time do you get to play this game? Until your spouse finds out what you've invested in, right? Which means if I turn off make it paperless statements, which I did a long time ago, she has no idea what we've invested in. She has no idea of the Twitter bet I made and the Valiant bet that I made. No. So I control my time horizon, which means I can wait and wait and wait. In fact, it's the advantage I have over the average active portfolio manager, right? Because an average active portfolio manager's time horizon is only as short as his most impatient client. So I can wait. When I sell short, what happens? What do? I borrow shares from somebody and agree to return the shares at some point in time. So I knew this question was coming because the numbers were so different. I knew it was coming. So I called around in the week before I did this webcast. I called brokers and asked, how long, if I sold short on Amazon, how much time would you give me? This is the peak of the dot-com boom. Demand for shares was incredibly high. You know what I got? 6 weeks. That's the most time I would have been given by a broker to sell short. I might believe the stock is overvalued, but there's no way I'm betting on the correction happening in 6 weeks. And it's something you have to remember. When you find something overvalued, before you jump in, you've got to ask yourself, is time going to be my ally? And with selling short, time, it's become better. It's easier to sell short for longer now. You can buy puts now on some shares. But it's still an asymmetric game where it's much easier to take advantage of something being undervalued as a long-term strategy than it is to take advantage of something being overvalued, which means you're far more likely to see bubbles on the upside than bubbles on the downside. So I'm going to revisit the assumptions as I'm going along because, as I said, I still take things I do in that Amazon valuation and they show up when I value Twitter or when I value Snapchat in a couple of weeks when the prospectus comes out. You will see the same techniques I used in Amazon play out. And this is actually the basis for the simple Ginzel spreadsheet, right? Revenue growth, target margin, sales to cap. It comes from this Amazon valuation. So let me draw some lessons from this valuation that are still general lessons that I draw on whenever I value a company. First, remember that cautionary note I gave you about regression betas and not trusting them? And I said, don't do that. With young companies, this applies in spades. And here's why. There was the Amazon Bloomberg beta page in January 2000. So if I trust the beta page, the raw beta is 2.23. The adjusted beta, of course, is the raw beta moved towards 1. It's 1.82. This is good, right? I have a regression beta for Amazon. But before I use it, what do I need to check? I need to check the standard error of the beta. And the standard error of Amazon's beta was 0.50. So let's review basic statistics. Raw beta is 2.2. The standard error is 0.5. The true beta for Amazon can be with 95% confidence anywhere from 1.2 to 3.2. If you think regression betas are screwed up with regular companies, they're triple screwed up with young startups. So you try printing off the beta for GoPro. You will be shocked at how much noise there is in the process. Never ever use a regression beta when valuing a young startup. It's a recipe for disaster. So you're saying, how did I come up with the 1.6 beta? I took 50 online retailers and I took the average beta. Each of them is screwed up, but by using 50, I got some measure of averaging across bad numbers. And then I used the beta for across all retailers, which is my end beta. So once I had those framed, I could do my cost of equity without ever looking at a single regression beta. Second, let me talk about the number that I wrestled with the most. Remember the 1.1 billion in revenue? I knew the number was going to grow, but the question was to what number? Now, the way we normally do discounted cash flow valuations is we work sequentially through the years, right? We do year 1, then we do year 2, then we do year 3. Don't do that if you're doing a young startup. You will go crazy by the time you get to year 5. I talked a little bit about this in the context of Tesla. To come up with the revenues for Amazon, here's what I did. I took the 10 largest retailers, not .com retailers, but regular retailers in 2000. I forecasted out what their revenues would look like 10 years later, which is not difficult because these were established retailers with single-digit growth numbers. I came up with the 10 largest retailers in 2010. Then I asked myself a question. Assuming Amazon continues to grow, where would I put them on this list? And I might have decided it's not top 10, maybe I'd put it 25. I had a pretty optimistic view about Amazon. I liked the company, I liked the management. I thought it was going to succeed. I assumed that if they succeeded, they would become the 6th largest retailer in the world. And if you look down that list, the 6th largest retailer had revenues of about 40 billion. So where am I now? I'm at 1.1 billion. I need to get to 40 billion. So ask me how I came up with these growth rates in year 1, 2, 3, 4, 5. I just made them up. I have no shame about admitting it. And if you really contested me on each of these numbers, I'd concede it to you. So you came back and said, I think revenue growth next year is going to be 163%. You can have it. You want year 2? You can do that too. Give me the starting and the ending numbers. I control this valuation. It's a lesson we forget with young growth companies because we get so focused on year-to-year changes that we lose sight of the fact that it's the end game that drives these valuations. The only rule I followed was as the revenues got larger, I lowered the growth rate simply because a compounding effect gets more difficult to do. So if you felt that 150, 150, you wanted to use 160, 90, go ahead. As long as you have the same starting and ending numbers as I do, your valuation is going to be pretty close to mine. So that's how I got my revenues from year 1 through 11. Then I turned my attention to my margin. Remind me again what I'm starting with? Minus 36.7. What I'm ending with is 10. I did this with a Tesla case too, which is to fill in the middle numbers, I had to use a very simple algorithm. Here's all I did. I moved half the distance towards my goal each year. I'm at minus 36.7. I want to get to plus 10. That's a 46.7% difference. I moved half the distance. You're saying, why half? Why not? You want to use a quarter, you get the same starting and ending numbers, but you will lose money for a longer time before you turn things around. It was the simplest way I could give you control of the pathway to profitability. So if you were more pessimistic than I was about profits becoming high soon, all you'd need to do is move a quarter of the distance or a tenth of the distance. You'd lose more money for a longer period. So that made my losses into profits, and you can see them show up in my operating income. First year I'm losing money, no taxes. Second year I'm losing money, no taxes. Third year I'm losing money, no taxes. Fourth year I'm making money, no taxes. And the reason, of course, is I'm carrying forward my NOLs. For those of you who have net operating losses in your companies, this is the best way to show it in your cash flows. Is not hold it separate, but remember the benefit of an NOL is it'll save you taxes. Just bring it into your analysis. And in fact, I don't pay my full taxes till year 6 or year 5, because even in year 4, I'm still getting a tax benefit carried over. So I have to keep track of the NOL. So my after-tax operating income reflects my tax benefits from NOLs. And yeah, go ahead.
For this 40 billion number, do you factor in population growth rates and inflation?
You have to, in a sense, right? Because those will already be in the numbers that you're seeing in the regular retailers. So when I did the Walmart revenues in 2010 and the Target revenues, what I built in was the nominal growth rate, which reflected almost a 4% inflation rate in 2000 and expected real growth in the population. So across my competing companies, I am building in inflation. Okay? It was exactly with the real and the nominal growth built in. So you can start with the existing numbers, but you have to build it in, especially in periods like 2000, the inflation was higher. I had to do that. Right? Any other questions on revenue growth and margins? As I was doing all of this, I had to keep reminding myself that scaling up is hard to do. Because what am I doing? I'm scaling this company up at pretty high rates. So I'm going to show you a graph that I think acts as a sobering device when you value these young startups, because you can get caught up in the hype about 30% growth, 80% growth, 150% growth. This is actually a study that looked at IPOs and the years after the IPO. I mean, basically, you're focusing on companies that are viewed as star companies because they go public, because they're doing very well. So what this study looked at was the revenue growth at IPO companies the year of their IPO, and then 2 years after, 3 years after, 4 years after, 5 years after. So let's start with the good news. The year of the IPO, if you look at revenue growth at the IPO company versus the sector, the IPO company is growing 15% faster than the sector. You're saying, this is exactly why I buy IPO companies. 2 years later, you look at these same companies, the revenue growth is now only 7% higher. 3 years later, it's 3% higher. By the time you get to year 5, the companies become part of the sector. Most companies, high growth lasts between 3 to 5 years. So if you're asking me, why do you allow only 10 years of growth for Amazon? 10 years is already at the 90th or the 95th percentile of growth periods. Most companies, growth doesn't last very long. So one of your tasks when you look at a young growth company is to ask, is this the kind of growth company that can scale up for a longer period rather than a shorter period? And what do you have to look at? Are the competitive advantages, the barriers to entry it brings in? What does it do that's unique? So whether it's Uber or Groupon or Snap, you have to make the decision in deciding how much value to attach to the company. And that growth lesson we learned for mature companies applies here as well. Just because I have a young growth company doesn't mean I can throw all those lessons out of the window. So as I grow and my revenues change, I have to estimate how much I have to reinvest. And as I said, the number I use is the sales to capital ratio. I use 3 across the board. So every year I take the change in revenue. In year 1, it goes up by 1.7 billion. You divide by 3, I get the reinvestment. I get that each year. Incidentally, that I've left that number at 3 all the way through. But if you have a business with economies of scale, or you believe that number should change over time, you have the freedom to start at 3 and move that number over time to 5 or 6 or 7. If you feel that as they grow bigger, they don't have to reinvest as much to get the same amount in revenues. But that sales to capital ratio basically captures my reinvestment each year. And just to make sure I haven't created a dreamscape company, a company that can exist only on a spreadsheet, here's what I do. I take the current invested capital, which is debt plus equity minus cash. Right? If I've capitalized R&D, it's in there, which is almost nothing for Amazon right now. Every year when you do reinvestment in a free cash flow to the firm, we don't think of it in those terms. It's actually a change in invested capital. So basically, I add the reinvestment onto my invested capital. I get an invested capital over time. By the time I get to year 10, based on my reinvestment assumptions, I have $13.1 billion in invested capital, which if I divide by my after-tax operating income, yields a return on capital of 20.39%. You're saying, so what? That's a number I can look at and say, am I comfortable with that number? With Amazon in 2000, I was okay with it. It was a really high number, but remember, these were risk-free rates of 6.5%. The average return on capital in the retail sector was about 18 to 19%. So I said I can live with 20.36%. Would it have made me uncomfortable if this had been 200.39%? In which case, what's the spreadsheet telling me? You're not reinvesting enough. And if I'm listening to my own spreadsheet, what should I be fixing? If I'm not reinvesting enough, what's the easiest way to fix it? Take the sales to cap ratio, make it lower or higher? 50-50 shot. You make it lower. As you make it lower, your reinvestment will expand. Check to see what you return. Your spreadsheet is sending messages to you. You're just not listening to it, right? So one reason you want to keep track of your own company over time is to answer the question, am I okay with the company I'm creating in my spreadsheet? Because if you're not, I'm not either, and nobody else is. So that's the hidden component in reinvestment. Now this is a point I made earlier, but let me re-emphasize it. Remember those 6 years of negative cash flows I had? And I said I was going to cover them by issuing new shares each year, right? Which means that I'm going to have dilution in my share count. And when I divided by the number of shares, I didn't seem to factor that dilution in. And the reason I didn't have to do it was very simple. If you go back to my cash flows, and you look at those first 6 years of cash flows, the present value of my cash flows over the first 6 years is about minus 3 billion. Just take the present value of the cash flows. In other words, my value for the operating assets of 14.9 billion would have been about 18 billion if I did not have those 6 years of cash flows. That 3 billion that I'm taking off my value is the adjustment for the dilution. I don't want to double count by counting it again, which is part of the reason when I do my DCF, it's already in there. I don't have to count the shares that are going to come from dilution. I don't have to count the shares that are going to come from those options because so I've taken care of all of those loose ends in my DCF already, so my share count can just be my share count from today. Now there's one thing that was hanging over this valuation that I completely ignored in January 2000. Most young companies don't make it. This is actually from the Bureau of Labor Statistics in the US, and it's actually a fascinating database. I'll give you the link if you're interested. And what it does, it looks at the startups by business and looks at what percentage of startups survive 1 year, 2 years, 3 years, 4 years, 5 years, 6 years. It looks at survival rates. And if you look at across all firms, only about 30% of the firms that get started make it through year 10. You say, what's so magical about year 10? Why did I pick year 10 as my ending point? Because that's what in terminal value, that big gigantic number that always saves me, always happens in year 10, right? So in all my companies, salvation, nirvana is always waiting for me in my terminal value, and I just have to claw myself there. The problem that this sheet tells me is that might not happen. Many of these companies will not make it. So when you're valuing a startup and you use a revenue growth and margins and sales to cap, and you come up with a DCF, you value this company as a going concern. And January 2000, I was an optimist about these companies. I assumed access to capital is always there, that these companies would survive. But let's say you were worried that the company would not make it. The DCF value you get is for the going concern. What will happen if Amazon doesn't make it? Let's say you invest in January 2000, it runs into serious trouble, like many other .com companies did. And what happened to the rest of them? They all shut down and you got nothing. Your discounted cash flow value will then have to be an expected value across two outcomes. The DCF value times 30%, if that's what you think the likelihood of succeeding is, and 0 or a very low value times 70%, which is your expected value. For venture capitalists, this is a big issue, right? Because if you look at, especially for venture capitalists providing angel financing to very young startups, you know that most of them don't make it. You'd like to believe that they do something like this, a decision tree, but they don't. You know what they do instead? What discount rates do they claim to use? What's the target rate of return for an angel financing venture capitalist? You'll see. For an angel financing, it's 20-25 will be way too low. You're talking about 50 to 60%. As you go further down the VC thing, you're probably looking at 30 to 40%. No going concern has a 60% cost of capital, ever. Saying, why did they use 60% then? You know what they're using the discount rate for? They're using it as a receptacle for all their hopes and fears. They're saying, I'm worried about the company not making it, I'm going to pump up. It's a very dangerous place to put it because the discount rate is no longer a traditional discount rate, right? It's trying to capture all these other things about cash burn and survival risk. I think you're safer doing a traditional DCF with the meaningful discount rate and then adjusting for survival by bringing it in explicitly. Because if you're a venture capitalist who's really good at forecasting survival, and that's what makes you successful, you want to know what you're doing right. And this allows you to separate the two. Any questions about failure and bringing it into valuations? Yes? It's exactly right. So DCF value times, think of it as a decision tree. There's a DCF value, going concern probability times DCF value, failure probability times whatever you get in failure. And with some young startups, you might have assets you can liquidate and get something at least. With tech companies like Amazon, there might be nothing left, right? So just an expected value across the two. It's as simple as that. Okay. Any other questions? So I finished the valuation, and after the sell short question, and I dealt with it and think they took it for whatever it was worth, I get a final plaintive question. And the question was, is it possible that Amazon is worth $84 per share? This must mean somebody owned Amazon in their portfolio. What's the answer to the question, is it possible? That's such a weak question. Of course it's possible. In fact, I can tell you what needs to happen to get to 84, right? What are my two big assumptions? Revenue growth and target margin. I use 42% and 10%. If I used a higher revenue growth and a higher margin, I'm going to get a higher value per share. So I did a little what if around those. See these shaded areas? Those are the combinations I will need to get to $84 per share. So here's the bottom line. If Amazon can grow like Walmart and have margins like Ann Taylor, then everything's going to be okay. There is a break-even point for every company. And one way to think about whether you're okay with that break-even point, just compute it. Take your two biggest assumptions, put it into a matrix, see what you will need to break even. And then ask yourself, are you comfortable investing on the belief that that's going to happen? So you finish the valuation. Did I make a lot of assumptions along the way? Revenue growth, margin, sales to cap, survival. At the end of every one of these companies, I have to remind myself that I'm going to be wrong, I'm going to be horribly wrong, and I'm going to be wrong 100% of the time. And it's not my fault. This might seem very it might seem like I'm patting, it's okay. It's really not your fault. When you value young startups, the uncertainty you're dealing with is not because you didn't do your homework. There's real uncertainty out there. It's not your fault. And here's the consolation prize. You don't have to be right to make money. You just have to be less wrong than everybody else. I know that sounds like a really low standard, but I think we forget that. Especially if you're coming from a quantitative background, you want to be right. Let go. It's okay to be wrong. As long as you're less wrong than everybody else, you are going to be okay. And with these young startups, you can be horribly wrong and still be less wrong than everybody else because at least you're trying. They're using price per user or price per subscriber. At least you're trying to come up with the revenues and margins. And to kind of emphasize what I mean by less wrong, I told you I started valuing Amazon in '98. I valued Amazon every year since. So this will be my 19th year valuing Amazon. I've bought Amazon 4 times. I've sold Amazon 4 times, which kind of tells you where I am with Amazon right now, because the game always started with a buy for me. In 2000, when I valued Amazon, it looked significantly overvalued, 84 versus 34. I did nothing. I told you I didn't feel comfortable enough, not courageous enough to go and sell short. A year later, I revalued Amazon. The value of Amazon had dropped from 34 to, because the dot-com boom had bust, the economy had gone into recession, my value dropped to about 24. You're saying, that's awful. Your value went from 34 to 24. But the price went from 84 down to 11. The stock went from being massively overvalued to significantly undervalued. I bought Amazon for the first time in 2001. I sold it again in 2003. This is actually not uncommon. When you see these young companies come into a sector where people are not sure what to do with them, it's essentially the market acts almost like a manic depressive. It overshoots, everything's great, and undershoots. The last time I owned Amazon was in 2011. But here's what keeps me humble. I've thought Amazon is overvalued since 2011, and it gets more overvalued each time I look at it. Either I'm missing something incredibly basic in this valuation, the market's going to be wrong a really long time before it adjusts. I'm not willing to bet against this company because it takes such long periods to adjust, but I'll wait. Sooner or later it'll be cheap again, maybe in 2022. And as long as I have money left in my portfolio, I can buy Amazon then. You know, the most humiliating thing about evaluation is 10 years later, you take your forecasted numbers and you compare them to the actual numbers. This is like a reminder. This is how wrong you can be. So at the risk of grave injury to my self-esteem, I decided to take my forecast from 2000, because I had forecast through 2000, and compare them with the actual numbers that came in Amazon. So I'll take you through what my forecast in 2000 looked like. Okay? In 2000, I was forecasting revenues of $51.46 billion in 2014. The actual revenues came in at $85.2 billion. The company's delivering far more revenues, and you can see why, right? It got into markets I never saw coming in 2000, the entertainment market, the cloud computing market. So if you're looking at the company, clearly they outperformed on the revenue forecast. My forecasted operating income in 2014 was $5,146 million. Their actual operating income was $97 million. I was forecasting an operating margin of 10%. They were at 0.11%. So in 2015, as I sat down to value Amazon, I had to learn from my lessons. Clearly, the company is not doing what I thought it would do, which is, as it establishes itself, it's going to go for profits. This is a company that doesn't seem to want to do that. And I should have seen that coming, right? Because Jeff Bezos in 1997, when he described his culture for the company, he said, we're going to go for revenues first, and we're going to worry about profits later. I didn't realize how much later he was talking about, but he said later. But clearly, later for him could be 30 years from now. That's why I called Amazon a Field of Dreams company. Remember the scene from Field of Dreams? When Kevin Costner builds his field in the baseball field in the middle of Iowa, where there's nobody playing baseball, and somebody asks him, are you crazy? Why are you building a field in the middle of nowhere? What did he say? If you build it, they will come. And he was talking about Shoeless Joe Jackson, but that's exactly what the Amazon story is. If we build it, revenues, they will come, they being profits. So in 2014, I valued Amazon as a Field of Dreams company. And what does that mean? Well, in my valuation, my revenues continue to grow at 20%, which doesn't sound like much relative to the 42%, but now we're talking about an $85 billion company. It's already the third largest retailer. It's growing revenues at 20%. Its revenues in 10 years are going to be $250 billion, which will make it the second largest retailer in the world, next to Walmart. And as they're growing revenues, I'm going to keep margins pencil thin, not improve them like I did before. Why? Because if the Field of Dreams model, the way they're growing revenues is they're going to give you Prime at $99, even though it costs them $3.99 to service a Prime member. They're going to give you the Kindle at cost. They're going to sell you the Fire Stick for $40. Why? Because they want to build up revenues, and once they have the revenues, they'll find a way to make money. So the margins stay small, and then they build up over time. The value that I got per share in 2014 with the Field of Dreams story, revenues growing, margins staying low, reinvestment reflecting that revenue growth, and finally a cost of capital that now reflects a three-business company. It's no longer just a retail company, it's retail plus entertainment plus cloud computing. Gave me a value 175. Companies like Amazon, Tesla, Netflix, people have strong views in either direction. So I put out this value, I get hit in both directions. One direction I was, oh, this company's worth nothing. The only dream they have is a delusion. It's Field of Delusions, you'll never make money. In the other extreme, I was told, hey, this company is going to make immense amounts of profit, you're not capturing it. So I decided to tell a second story. In this story, it's a conspiratorial story. Amazon is going to go for world domination. They're going to sell Prime to every person in the world for $99. And after they've driven every other retailer out, you know what they're going to charge you? $9.99 a year. Where are you going to go? There's only one place to buy stuff, Amazon. I know it sounds conspiratorial. Hey, but looking at what Amazon does, it's not improbable, right? It's definitely not impossible. So here's what's different. In this model, I grow revenues at 20% for long. So basically, I end up with a $336 billion revenues in year 10. My margins improve to 12.84%, which is the 90th percentile. I'm sorry, the 75th percentile rather than the median. So basically, they have high margins. And the value that I get per share is $463. You see, how the heck did you get from 175 to 463? If I build into the story of them being able to get the revenues and then be able to charge really high prices and get high margins, they're worth 463. So if you find somebody disagreeing with you on Amazon, before you jump down their throat saying this is an overvalued company, listen to their story. Maybe they have a story that's driving their valuation. There's a third story you can tell. Remember the Field of Dreams story that I told you, that if you build it, they will come? That assumes that Jeff Bezos actually wants to make money. What if he doesn't care anymore? I mean, how old is he? Almost 60? Maybe he wants to leave an imprint on the world. Maybe he wants to be the Dalai Lama. In which case, you're in real trouble as Amazon stockholders, because what's he going to do? He wants to change the world. Profits are not even an issue. He just wants to devastate the retail landscape. He doesn't care about making money. So in this story, Jeff Bezos basically goes for more revenues. He's never wanted to make profits. He's just never told you that. The margins stay low. The revenues climb. The value per share that I get is $33 per share. If Amazon never makes the margins that you hope they will make, they're worth almost nothing. This is a company where the story is essentially, again, going to drive big differences in valuation. So I'll put all 3 Excel spreadsheets up. You go play with them. Update the numbers to 2016 numbers. Bring in the information that's come out since 2014 about the story. Because there are now glimmers that look like Amazon is going to go for profits. They're shutting down divisions that are actually not making money, which was unthought of 2 or 3 years ago. Maybe this is the start of the next phase of the game. But it'll be interesting to watch how the game plays out, because as you know, Amazon was down, what, 10% last Friday? Don't do anything crazy like say, oh, it's down 10%, let me go put all my money in it. Look at the story, come up with the value, compare to the price, make your own judgment on Amazon. It's a fun company to value simply because the story is going to drive every aspect of your valuation. Any questions about young startups? Yes?
For your Amazon as a world dominator,
Yeah.
you have a higher revenue growth rate than Amazon Field of Dreams.
Yeah.
How counterintuitive?
Well, because as a world dominator, they're going to go with the same strategy they had with the Field of Dreams. The only difference, the Field of Dreams model, I'm assuming that new competition will keep emerging from, not from traditional retailers, but from other ways of delivering online, Zappos, and that they will keep popping up. You can't kill them. They'll keep popping up, so the margin stays low, as the revenues grow. So the margin stays at the median. The world dominated, they're so powerful that new competition ceases to even try. They get squashed, like Jet.com, very quickly pushed down, which means so the big difference between the Field of Dreams and the world domination, it's not so much the revenue growth. You go for more revenue growth, but what they end up with at the end of the revenue growth. They end up with almost monopolistic power in this business, which allows them to charge the margins. So they have to go for more revenues because they have to drive more people out of business to be able to do that. So in any world domination model, you need big revenue growth plus driving out not only existing competition, but new competition, which shows up as higher margins. Okay? And as I said, it's not an improbable story. It's done it in so many different businesses that you got to wonder whether this is in fact is what's being hatched out in the headquarters in Seattle. No. Yes?
So some of the assumptions, I guess, for a company like Amazon, where okay, after 5 years you can't expect this above average industry revenue growth. When you deal with smaller companies like emerging industries, fragmented kind of niche industries, because you're dealing with smaller numbers, is it possible to have those kind of margin targets?
You could, but you got to be careful. There's small companies and big businesses where there are other people also looking at those big businesses, right? So you have to have small companies plus something special in that company where you feel that this company has a significant advantage over the rest coming in. I'll give you the classic example. When Groupon first came about, people put these high revenue growth rates because it's going after the excess capacity business, right? Because if you're a restaurant, you have 65 seats and you fill in only 35. So that's a big business. What they missed, though, was Groupon went after that big business, but because there were so few barriers to entry, so did Living Social Media, so did Amazon Deal of the Day, so did everybody else. So at the end of the process, Groupon's growth rate actually started to droop much quicker than people thought it would, simply because of competition. So it's both a product of the size of the market and the ease with which competition can enter the market. You almost need a big market with very limited capacity for competition to enter to be able to put that revenue growth for a longer time period. Okay. Yes?
So in businesses where there's going concern risk and with products like pharmaceuticals, do you bring that into
No, don't, because you have a portfolio. The way to think about, did everybody get his question, which is individual drugs. So Amgen, for instance, was down, what, $15 per share on Thursday or Friday when their earnings report came out because one of their drugs looks like it's going to be potentially challenged. So with individual drugs, you obviously have survival risk, which is if something bad happens, the drug, but the way I think about pharmaceutical companies is I think about them as a portfolio of drugs. So if you're doing a big pharmaceutical company with 30 drugs, you have to think about the portfolio and you have to think about the potential. If you're doing a biotech company with one big blockbuster drug and very little else, then the two are tied together, right? Because one fails, the other fails as well. You're really valuing, it's more like a capital budgeting project than a valuation. It's valuing one drug, and there you have to bring in the failure risk more explicitly into the valuation, because if that drug goes down the drain, so does the entire company. Okay. Yes?
Can you talk about number of shares? So over time, financing growth and financing the gap through issuing new shares, and then in the present period, that number of shares in the current period, present period, versus in those future periods. When I think about that, my mind starts spinning a bit because we're going to be having all these future share issuances that aren't reflected in the current.
Why are you issuing the future shares?
In order to pay for the reinvestment rate.
In order to cover the negative free cash flows, right? That's why you issue new shares. Are the negative free cash flows already affecting your value?
Yes.
Yes. That answers your question. If they're already affecting your value, you can't count the shares and the negative free cash flow in the same valuation, right? So once you do a DCF and you're discounting the cash flows and those cash flows are negative, you've already counted in the share count effect. You can't adjust the share count for those shares you'll issue to cover the negative free cash flow because that would be double counting.
I don't exactly follow though. I mean, a negative cash flows in a future period, I'm expecting that would be issuing future shares.
No, forget about issuing new shares. When you do the DCF, what does the negative free cash flow do to your value? Reduce the value by about $3.5 billion. That is your dilution effect already in your DCF. So when I value Amazon at $14.9 billion, without those negative cash flows that are valued at $18.5 billion, I've actually applied a 20% discount to the value because of future dilution. And if I now adjust the share count for the same thing, that will be the double counting. It's almost magical, right? Because in a sense, you think about share count and you say, oh my God, the share count is going to change. And I'm saying, let it go. Right? If you do a good DCF, the share count is already taken care of through the cash flows. And it's a huge weight off your shoulders, because to do the share count adjustment, what do you have to estimate? The price per share. And this becomes a circular logic, right? You have to figure out what the price per share will be in year 1, year 2, year 3. I've saved you the trouble. Now just work with the DCF. Now let's talk about mature companies in transition. Now, normally when you value mature companies, because they're set in their ways, history is a good indicator of the future. Right? But sometimes you can get set in bad ways, right? You can start doing things because that's the way you've always done them. If the business changes, then your value will change as well. So let me frame this again in terms of those 4 questions. You have a mature company, and things are changing. You used to be, it could be McDonald's, it could be a it used to be a high growth company. You went global, you were growing 8-10% a year, everybody wanted to eat fast food. Now the world has shifted under you, partly because of health reasons, partly because of competition, partly because of saturation. And I ask you, what are your cash flows from existing assets? You can give me your cash flows from the existing investment, but you might be in 5 businesses, 2 of which are really bad businesses and 3 could be really good businesses. Okay? When I ask you what the value from future growth is, the growth might not be high, but it could actually be value destructive. You're investing in businesses where you have no business investing in, and it's actually dragging down your value. So to the extent that you shut down those 2 bad businesses, the historical numbers no longer make sense, because you're now going to be reinvesting nothing in those businesses and perhaps growing lower at a lower rate but having a higher value. When I ask you what the risk of your company is, again, what stays in the company and what you're getting rid of. And when I ask you when will you be a mature company, your answer might be it was 3 years ago. Now you wish you were mature now because things have changed against you. So let's look at how this plays out in valuation. I'm going to pick a company that some of you might be familiar with, a company called Hormel. You know what its most famous product is? Close, but not. The most disgusting product ever made. Spam. You know what spam is? It's ham in a can with a life of 100 years. Think about that. How the heck do you get meat in a can? It was actually concocted in during the 1940s as the U.S. Army was coming back from Japan. They landed in Hawaii. And if you go to Hawaii, there's not enough food there to feed all these people. So Hormel came up with Spam as a solution. And if you go to Hawaii, you can actually get entire cookbooks on Spam. Don't buy them. It's disgusting no matter how you cook it. They have fried rice with Spam, Spam stir fry with broccoli. I mean, you can try different things. It's a company that's been around a long time. Many of these food companies, for some reason, happen to be in Pennsylvania. I don't know why. Maybe that's where the Spam was created, whatever it was. And they're set in their ways. They're run by very conservative managers, and that's again a common feature of these companies. Conservative in what sense? They hate reinvesting outside the US. They think the world ends at those borders. Even Hawaii, I'm surprised they made it out there, saying that's across an ocean. And they all have family foundations as their largest stockholders. So keep that all in mind. In my initial valuation of Hormel, I reflected the status quo, the existing management running it, which reinvest very little. Their reinvestment rate was only about it was about 19%. And given that low reinvestment rate, they have a low growth rate. And they use very little debt. So it's a very conservative company. It doesn't reinvest very much. It doesn't borrow very much. And based on the assumption that they would continue to do that, the value per share that I got was $31.91. So it's a status quo value reflecting conservative management. Then I did a second valuation with somebody more aggressive running the company, not the existing management. Aggressive in what sense? Aggressive in reinvesting more, even if it meant accepting lower returns on capital, and perhaps overseas. And aggressive in terms of how much debt they use. And the debt ratio that I used, instead of being the 10% debt, I just doubled the debt ratio. I'm not doing a leverage buyout or something crazy. More debt and more reinvestment. With those changes put in, I get a higher growth rate because they're reinvesting more, and I get a slightly lower cost of capital. The value per share that I get is $37.80. I have two values for the same company. $31.91 with the existing management running the company, $37.80 with somebody else running the company. Let's say the stock is trading at $33 per share. See why it challenges an investor now becomes a tough one. Relative to the status quo value, the stock looks overvalued. Relative to what the value can be if somebody else ran the company, it looks cheap. You now have to make a final judgment, right? Which is, what is the probability that somebody else can run the company? Remember we talked about corporate governance? So to answer this question, here's what I did. I went and looked at the top 17 stockholders in Hormel, asking, if somebody came in to do a hostile acquisition, what's the chance that they will succeed in this company? And the biggest stockholder, as I said, in Hormel Foods is the Hormel Foundation. The original family that created the company owns about 21% of the shares. And I went and looked at the Hormel Foundation's board to see who was on that board. And the CEO of Hormel was also the CEO of the foundation, which is actually not uncommon with those foundations. My assessment of the likelihood of change dropped off pretty dramatically. It didn't drop to zero because Hershey's had the same phenomenon and there was change that happened there. It dropped only 10%. What does that all mean? There's a 10% chance of change happening, and the value is $37.80. There's a 90% chance of the status quo with 31.91. The expected value for Hormel Foods is then going to be the expected value across those two numbers. The value that I got was $32.50. You know what might cause it to change overnight? What kind of news story would I have to see in the Wall Street Journal that would lead me to reassess these probabilities? Nelson Peltz, or not dies. First he's got to take a position. Nelson Peltz or a Carl Icahn or a Bill Ackman has taken a position in the company, right? Almost instantaneous. It's not that the values have changed. My probabilities have shifted from 10 to maybe 25 or 30. That's why the presence of activist investors can alter an investment decision overnight, because you can go from looking at a company and say, I will never buy that company, to, hey, that company might be a good investment for me if there is a potential for significant change from running the company differently. Very quickly though, be careful about these companies when they're on the verge of change, because they will talk about cost cutting, but in most of these companies it remains stock, because when you look at the actual numbers they don't deliver. So one of the things that the McKinsey quarterly looked at is what has to be true for a company to actually deliver on cost cuts. And then I would not read it. They're all fuzzy factors, but they point to the fact that not all companies are created equal. That when you see a company reporting cost cuts, you might have to look beneath the surface to see if those cost cuts are going to get delivered. Last page, and I will leave you with this page. This is from corporate finance. Remember that 20% debt ratio that I used for Hormel? So where did he come up with that? I just did an optimal debt ratio for Hormel. What's an optimal debt ratio? It's that debt ratio at which my cost of capital is minimized. So all I do at every debt ratio is re-estimate my cost of equity based on that debt ratio, re-estimate my cost of debt based upon the fact that I have more debt. My cost of capital would reflect both numbers changing. And for Hormel at least, if you look down, the optimal debt ratio is about 20% debt. So I'm not just going to pump up my debt ratio just because I have low debt. I did look at what was optimal, and that became my debt ratio and my cost of capital. So when you look at mature companies, if you're valuing a mature company, just do the traditional DCF for the moment, then stop and ask, is this a status quo DCF? And it'll show up in the numbers you used. And if it's a status quo DCF, maybe there's a second DCF you want to do later in this process. We say, what if somebody else ran the company? Because you could end up with a much different value. That's about it. I'll see you on Wednesday. Then you know that there's a margin cliff. It's not that the drugs are going to see through this, but the margins there right now 15% of drop to 10 8%. For all the startups, then you have a different problem. Some of these drugs are untested, they might have to take the drop. So you're already looking at the portfolio to see how they and that's why balanced portfolios are worth more than unbalanced portfolios, right? Because they show up and calculate the market. But there's nothing dramatic you have to do because if Amgen's not going to go out of business, even then around making as a block price to drop. It just means that the margins will be low and the cash flows will be low and the value will be low. It's not a survival risk per se for the company, it's really for the product.
So when you build up the cash flows, that's when you're going to capture the percentage of profit.
I'll tell you the bigger issue is when you have a company like Apple and you're getting 65 to 70% of revenue. That's where I worry about a single product falling off the cliff. Because that's exactly what happened with BlackBerry, right? It was an incredibly profitable, successful company, but you were getting everything from this one product. And the technological shift made that product no longer an attractive one.
Yep.
You went from being this incredibly profitable, high potential company to nothing overnight. So with technology companies, because of the type of life cycle, you can fall off the cliff so much faster that you have to be a lot more careful about what you build into the business. So that, I would be more worried about technology companies getting the bulk of their revenue from a single product than I would be with pharmaceutical companies having a blockbuster. Thank you. What did you ask me?
I got two questions. First is about the bottom-up data. Because
So they have one line that's
they're every
operating and producing right now. They have another line that's going to
so
be
there are
going
a
FID
few
right
companies
now.
were
And then they have exploration.
This is like system software for
it's a hardware. Like they put up something like this in your car that they work mainly with the
So why not just use the
OEM.
data of automobile companies? Why even look at software? It's an auto accessory, right? That new cars.
So I think you should actually include their company like the OEM for
Exactly, that's what I mean.
automobile companies, like the automobile manufacturers themselves. But there's a list of about, I don't know, maybe 30 companies with like companies or developing the driverless
You want to
cars.
kind of have a subset of companies that are primarily auto, because Google and Apple get some, but their percentage of the revenues in this business is so small that you don't want to use them, right? So I'd go to the auto OEM market, which is an old market, right? Market companies that supply tires and the pieces that go into the automobile companies and stick with that business. Because is this a product that only the auto manufacturers would buy, or is it something that I can go buy as an individual?
It's possible, but most of the revenues come
Then
from.
I would tie it to auto OEM companies, traditional auto OEM companies.
I guess like it could be the same companies that are relevant to Tesla, for example. So
Right.
it could be also the manufacturers.
Yeah, that's what I would say.
Okay, so the OEM. And the other question was about the growth